Money FM 89.3. Best of breakfast. Companies to watch.
All right, let's talk about today as we get the earnings season into full swing in the US at least. And helping us out, Dan Koh, good morning.
Good morning, Ryan. Tons of numbers to break down today, so let's get right into it. Welcome to Companies to Watch. That's a segment where we spotlight and stock up with ideas of companies that will call for your attention. So market trends to risks, hidden gems or warning signs to steer clear of. Be part of the conversation, 8855-0893. And tell us whether you think it's going to be a hot or not. Ryan, you ready?
Let's go, Dan.
Okay, today we're going to be talking about US big banks, more specifically Morgan Stanley, Wells Fargo, and JPMorgan's latest earnings results. And Goldman Sachs as well, of course. They've just reported just last night. And it kicks off the first quarter of 2025 and sets the stage for what to expect for the foreseeable future. So let's dive into the numbers of Morgan Stanley, which has seen stock traders delivering first quarter revenue exceeding analyst predictions. On top of that, the firm earned a record $4.13 billion from equities trading in the first quarter. Investment banking fees rose 8% as well. And Morgan Stanley did say that in its earnings statement that the increase was principally driven by realized gains on the sale of corporate loans held for sale. Overall, must say Morgan Stanley did relatively well, and we're seeing the same mood across all the board. Wells Fargo also had its profit beat expectations in the first quarter, and that comes as the bank cut costs and set aside less money to cover potential loan losses. We've got, their earnings per share at $1.33. That's higher than expected. Overall, the lender's expenses had also fallen by 3%. Good news there, with JPMorgan also topping first quarter profit estimates on record equities trading and higher fees from debt underwriting and advising on mergers. Now, earnings were standing at about $14.6 billion for the first 3 months ended March 31st, also higher than a year earlier. Trading revenue climbed 29%, higher than the earlier expectations of a low double-digit percentage gain. Equities trading also surged 48%. All in all, it does seem like the three banks which reported numbers last Friday had relatively good news and to kick off the start of this year. What about Morgan Stanley?
Goldman Sachs as well,
Goldman Sachs, yes.
Reporting a 15% rise in first quarter profit. So all in, there's a common thread running through these banks, and that's with the equities trading business doing quite well, as we've seen US markets outperform, at least in the past few months. Also doing well is what's going on with the M&A side of things, the underwriting fees, the capital raising stuff. That's been okay as well. So the big question is, what's going to happen next? Because of all the tariff talk, all the tensions, is this still going to have momentum, especially when you see some of these IPOs being put on ice? That's going to potentially have an impact on the business. People are talking about maybe storm clouds to come. Will we be bracing ourselves for these banks to put aside more provisions for bad loans? That sort of thing.
Yeah, certainly. And the results that we've seen so far, it does offer investors to look at how the US economy fared in the early days of Trump's second term. But beyond the numbers, investors would be eager to know what these executives' predictions are on how consumers and companies will start to contend with economic uncertainty. That's following Trump's tariff announcements, which have whipsawed markets as we've seen lately. So here's one common theme across the board, Ryan. At least for JPMorgan, Wells Fargo, and Morgan Stanley, all of them don't know when it will settle, and nor do they know what the actual transmission effects will be on the real economy. So I think as of this now, most of them remain wary about a possible global recession this year, with JPMorgan saying that, they're estimating a 50% chance of a US and global recession this year. That's still down about 60% earlier this month, but 50% doesn't really help the fact that, doesn't really look as bright as we thought it would be. Wells Fargo also warned that US tariffs risk slowing economic growth, and according to their CFO, they're expecting full-year revenue or net interest income to be in the low range. And also we've got CEO Ted Pick of Morgan Stanley saying that the simple truth is that they don't know when the policy will settle, and that the markets will continue to calibrate further as, the trade policy against the tax and deregulatory pillars of the agenda starts to become a little bit clearer. So that being said, I think as of now, I'm probably going to go with a warm start for US banks because I think people are more focused on how predicting in the foreseeable future, and that kind of sets the tone for what to expect in the economy.
Yeah, that tone is important because it gives the signals for business owners how much to hire, how much to spend, how much to budget for. And to the same degree in Singapore, we saw the GDP numbers for the first quarter come out yesterday. We had a downgrade in the growth forecast for this year. The new range is 0 to 2%.
That's right.
That's down from 1 to 3%. So a bit of a downgrade on the front. And I think it takes into account the tariff environment where you have the US and China maybe cutting back on trading. And that also will play a part in how Singapore banks will report in time to come.
Yeah, certainly. I mean, just like what you've mentioned, and building onto that, the Ministry of Trade and Industry did mention that while, there had been a temporary 90-day pause in the implementation of the higher reciprocal tariffs, the tariff war between the US and China has continued to intensify, and the escalating cycle of tit-for-tat tariffs that's being imposed by both sides is likely to at least start markets in the next few months. So that is all we have for US banking stocks for today. Now, Ryan, do you know who or what is the oldest operating US bank?
Wow, that's a tough one. They are all pretty old. I'm going JPMorgan.
JPMorgan? Good try. BNY Mellon, established as far back as 1784. So why is it so hard for bank accounts to quit their addictions?
I'm not sure. Is it something to do with interest?
They experience severe withdrawal symptoms.
Okay.
Okay. Well, so why are we like a bank account?
Why are we like a bank account?
Because without a lot of money, we don't generate a lot of interest.
Okay, I got that one right earlier.
And that's all we have for US bank stocks.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.